This is like in Web 2. You have to explore how to be successful. A big part of the token engineering work is understand where a certain mechanism might break. And this is about risks and handling risk and rating risks, and then adapt the design.
But I think that perspective is something that protocol designers or like founders should keep in mind, that, okay, at the end of the day, it's like, okay, how much capital you want to raise with a debt that the debitor can cash in at any time. I'm here at Staking Summit in beautiful Bangkok, and I'm here with Robert, who's a researcher at 1KX, and Angela, who is founder at Token Engineering Academy. Thanks for being on the podcast.
Thanks for having us.
So you guys just gave a talk about profitability in tokenomics, which I thought was really interesting. And there's sort of lots to dissect here, but maybe first starting with a bit of background for both of you and how you became interested in tokenomics and being profitable with staking.
Okay. I started in 2017, 2018, when I realized that the design space for tokens is so rich and so exciting, because we can design mechanisms, we can define new roles of contributors in an ecosystems, we can reward them, we can align incentives, and there's so much to explore. Then I realized, together with a bunch of other people active in this space, okay, you can study nothing that really equips you well with the skills and knowledge needed. And in 2020, we launched T Fundamentals, a first course to educate people in this crossover, cross-disciplinary field that combines computer science, game theory, mechanism design, systems engineering, behavioral economics, and this is Token Engineering Academy. And since then, we have 5,000 students enrolled now, collaborating with Optimism, with Gnosis, with Ethereum, big players in the field, checking or seeing what challenges we have, how the space is evolving when it comes to mechanism design. And this brought us together talking about, okay, they're staking, one of the best explored mechanisms we have in the crypto sector. And how can the problems, the challenges we saw, and this brought us basically to this talk together. Yeah.
So I'm from 1KX, early stage venture fund. I joined a couple of years ago. My background is math finance, which first brought me to like, okay, can you help us understand like the DeFi space better? And then to like, oh, you can do all this simulation and data science and machine learning stuff. Can you actually help our portfolio companies in their token design? Which then expanded to like, okay, it's not just the simulation, it's the whole process of like legal marketing, the design itself, the implementation. And then besides that, also to, stay on top of like, okay, what's the latest and greatest on all these different mechanisms, what works, what doesn't work. Where you keep following the discussions of like, latest is about staking emissions, staking rewards, what's good, what's bad, what's sustainable, what's not. And we noticed that nobody's talking about profitability. Before staking networks, I was more narrowly looking at deepins and trying to understand profitability in the deepin sector, because there the cost basis is just even bigger, relatively speaking. But yeah, we can get into that more. But that's basically how we came into it and looked more into it.
So when thinking about profitability, I think there's like different ways to think about profitability. As a validator, obviously, like if you're running nodes, you want to be profitable. You don't want to be losing money running infrastructure. I think as a delegator, the question is less. You ask yourself that question less, right? Because you hold tokens, you delegate those tokens, you get rewards typically. You don't get like negative rewards. There's also like protocol profitability, which I'd like to talk about as well. But you guys have focused primarily on profitability when it comes to staking and looking at the differences between running your own nodes and delegating tokens. So at a high level, what did your research find there?
So yeah, I mean, it was a starting point to basically say, okay, as in any token design, you start with like, okay, what's the objective function here? Where it's like, okay, profitability is like a good measure to keep track of, and then different stakeholders, how does it look like, right? And staking networks, the core stakeholders are the ones that stake, which is two parties. It's either the guys running the nodes, or if you have delegation enabled, the guys that delegate to the nodes. And obviously them with different profiles, as you alluded to. And even there, you can dissect even further, right? Like if you look at the delegator space, right, you have like guys like me who are like, okay, I have some ETH. I don't want to run a validator. I'll put it into Rocket Pool or wherever because, you know, I'm too lazy to do it. And I'm happy to them take a commission and then, you know, I get the remaining yield. Whereas then, you know, us as a fund or like other institutional investors, they have my different criteria, right? Like talking about like not losing the money. There's also the whole point about like commingling of funds and all these regulatory requirements. So you have all these different requirements on each of them. And that obviously affects then the profitability as well because it sets constraints. And interesting thing is like seeing this across all the different networks is was quite unexplored or is still unexplored, and that's why we poked into that.
Yeah, and the token design, I think, and sort of the staking mechanism design between chains plays as well. In your talk, you focus quite a bit on ETH and Sol, but then there's all of the Tendermint, Polkadot type chains that have an entirely different economic mechanism behind staking, where you have delegators, and the question really is pretty clear, right? Like most people are just holding tokens are going to delegate. They're never going to run their own nodes just because they can't get in the top like 150 or whatever in the staking. So what are the different types of considerations that protocols should consider in terms of design? Yeah.
I think there are several steps protocols should take to design, for example, a staking mechanism. But generally, this applies to any mechanism designed to reward contributors, to secure your ecosystem, to contribute data or transactions, to generate fees. And sometimes I think people assume that as soon as you have a smart mechanism and some, certain can have a certain promise on rewards that contributors can make and gain, this is enough. But I think what's highly underrated is that you have to solve a problem or find product market fit. In staking, the situation is very clear compared to many other mechanisms. We try to find out many other problems that we try to solve, like with data storage or with deepins. For staking, it's about validations. We have well-defined roles. We have service providers. We have delegations, many routes to onboard token holders to make them participate, LSTs. In other areas, this is much more immature. And then the first step is, what is actually the value people can benefit from? What's the offer? And how to then define roles so that contributors can participate and profit. And this is the first steps you have to take. And this can't be done on your desk on a blank sheet of paper, and then you only have to build the tech and have some sophisticated mechanism design around it. No, this is like just in Web 2. You have to explore how to be successful. And only then, if you found this and if you found traction, then you can put, based on the knowledge you gathered on the roles, on the actual activities of the stakeholders involved, then you can start build a mechanism design that does two things. It makes it attractive, it offers a profit for those who are involved, and it secures the transactions, because you can always take two directions. It's about profits, the positive side, and it's about penalties, skin in the game. Let's say, make sure that the incentives of all players are aligned. And this is protocol design.
Mary, how important is skin in the game, do you think, for for funds, particularly? And maybe some context here, like we, in the early days of Interop, ran our own nodes for some Cosmos chains that we were invested in, realized that was like really difficult and, took a lot of time and energy and had like costs associated. So we ended up outsourcing that to professional validators that run nodes for us. And then for others, we delegate. So what kind of goes into consideration in terms of like as a fund, whether you should run your own infrastructure, delegate tokens, or maybe work with a white label validator service?
I think we touched upon a little bit in the talk, but I mean, we as a fund, of course, also run our own validators. We even have a dedicated DevOps person because this is like, not our money at stakes. Yeah, the very efficient one.
Is he up 24/7 or like does he sleep?
Yeah, for sure. It's up quite a lot, and has busy days, less busy days. But of course, we also delegate, right? We not for all the tokens we hold, we run our own validators. Because then we also invest in somebody like Kiln, and then obviously have that relationship as well. But talking about skin in the game, this is the core piece of staking. What also makes it this such an established mechanism, right? Because it's not the perfect, but it's like one of the great incentive alignments of like, I want you to provide something which is like, just security or like service for DePIN or even TVL if you talk DeFi staking. And then how can I make sure that you do this like properly and how I as a protocol want you to do it? Yeah, I let you buy skin in the game, right? And obviously as fund, typically have more skin in the game. But I find like the skin in the game thing is one of those mechanisms which is really, really good for staking, but also when we talk about initial distributions, right? I mean, ICOs were, right, besides all the bad things of the frenzy and the speculation stuff, but the core piece of like, you get to get your skin in the game very early on, and this is how you become basically part of the community early on and the supporter early on. This is something that in generally is really good, and that's why I'm also big fan of staking, and that's why we also dig a lot deep into how things work.
Yeah, I mean, I feel like for investors particularly, there's a lot of credibility that goes with like running infrastructure, or at least having your own validators in networks in which you're invested.
And you have to understand, right? Like to learn as well.
Absolutely, yeah.
You basically try the protocol. You can give feedback of like, hey, this is not working. Your documentation, what the fuck? Things like that.
Yeah. It's a wonder that that documentation is not as standardized as it could be, and that but best practices are not always followed by protocols. And in your work, like working with protocols, have like what kind of sort of standards have you seen become established over the years, or maybe perhaps that you've like helped put in place?
I think, of course, I'm looking at it from the journey of a project, from the first idea of, okay, this is what we'd like to do. This is how we'd like to reward. This is why we think we'll be attractive for users, for the protocol, to the mechanism, and then to verifying if this can be successful. Because big part of the token engineering work is understand where a certain mechanism might break. And this is about risks and handling risk and rating risks, and then adapt the design. And I think, just yesterday, I had some conversations on doing something, and we are very much tech driven in crypto. So meaning there's an idea, you know how, immediately, this is how the tech should look like, this is how we could make it happen. And then the steps to, wait, this would mean these are the players. What do they have to know? What do they have to know about potential profitability? How can we equip them with tracking their profitability, optimizing their profitability? This is a whole stack of tools that might be relevant to convince contributors to come on board and run transactions on your protocols. And since we have more and more competition, you have to, I think there's really a lot to gain here. It's just this ongoing iteration on, this is an idea, this might be relevant. How relevant? What's the size of potential contributors, stakeholders, users? Is it worth investing in this direction? What do they need? And then not only build, but have this feedback loop of what's really helpful, what's really relevant, what puts you apart, and not try to scale up or take the efficiency route too early. Because if you think you can optimize and just run efficiency infrastructure or build up efficiency infrastructure, you might miss the actual point in it. Because there's a lot of details in making your product, your offer successful, then build a mechanism informed by the insights you gained in the conversations with investors, with users. And establishing this feedback loop is really important. And then everything else, like how the documentation looks like, how the infrastructure, how the toolset look like, can be built on based on this information. So I would say then it's much easier to solve and much easier to decide on how to prioritize, because obviously there's a lot to sort out.
Yeah. So you had like these really nice charts and kind of came up with a number, which is the average revenue that a node operator generates per annum. And I was actually quite surprised that it was well, as low as it was. I expected it to be higher. But I guess like once you deduct infrastructure costs and like personnel costs and all that, your staking rewards or your staking revenues do take a big cut. So what can you kind of summarize the different costs and what are the average returns that validators are making per annum?
Yeah, sure. I mean, this goes back to like something we published earlier this year where we had the deep in focused article where like, okay, in the deep in service provider costs, right? Like if you run storage or like just some hotspot, or you have a cost to maintain it, to set it up and to maintain it. And it's something which obviously isn't publicly available, often on purpose, because often protocols want to gain efficiency by setting node operators into competition, right? Only the best 100 can compete, and then that's how a lot of the networks work like this. But that obviously makes it hard to say like, okay, you can run your own node and you understand what are your costs, but overall on the network level, setting these costs is hard. So you need to go really through all the components, labor, hardware, and then get some, economies of scale assumptions of like, okay, if you run 1 versus 1,000, you probably have some gaining here. But we published the whole framework. If people are interested, they can go to the 1KX website and read how we did that. And that can obviously be translated to like staking like POS networks, right? We can say like, hey, if you look into running an Validator, or Solana Validator, there's like the hardware costs, which I mean, for Validators, if you're really efficient, then that might be, you can break it down to $20. However, if you run it in the cloud and you don't care so much, that might be even more than $100, $200. Then you some people like how you factor in labor cost, all that stuff. Solar validators, right? Typical questions. I mean, they typically say like my cost is 0, but they're like, well, the thing still runs at home, has some power costs. It's low, but even if you put that aside, every time you claim, there's gas costs, there's additional costs. When you set up the node, this was one of the most surprising things to me. It also depends, like when you do it. I think if you set up a validator right now, it takes a couple of months, even be more than 6 months, I guess, to regain the gas costs that you have when you set up the validator, because gas is high, right? Like we're like, okay, do Solidators really time their? I mean, they probably set it up and then it's gone and then it's fine. But these big guys, Kill, Lido, I mean, they all the time like spin up, spin down validators. But anyway, taking all this, you kind of like come up with ranges of like, okay, what's kind of like a minimum you pay for your validator on the hardware side, on the hardware side, what's more the upper range. And then you just go through like, okay, looking at the current staking landscape where you're like, okay, it is, 80% like larger operators, right? Even on the Solar validator side, you wonder like how much of those is actually a node operator running multiple validators. And that's kind of like the addition, because this is a range on the cost side. Then on the income side, you also have a range, because it's not like everybody just gets the emission and that's it, because, it depends, where you be lucky on getting the rounds for validation, all that stuff. It is a wide range. The 3% is just basically the average. And then you just need to understand like, okay, that range from -40 to plus 40% APR, because somebody, got slashed or like, got taken away a little bit because they missed certain things. And somebody were lucky and had the big MEV block when it was their turn. And so they got the tip on that end. And if you take that together on an aggregate level, or basically like, okay, there's this like 50 bips, if you want to call it, between like, okay, what's your income sort of margin versus what's the profit margin. An interesting piece on that is, okay, what you bring together is kind of like the income is ETH, but the cost side is mainly dollars. So obviously, as ETH now pumps, that spread goes smaller, because and then I guess that's a little bit the idea also for your protocol design, to understand like how that fits together, right? Because it also goes the other way around. But when things go south, the dollar aspect becomes more and more. And this is when you look, for example, at Filecoin, where the cost is like way bigger. I mean, running these large machines, right, where some of them petabytes of storage, and this is not something you run from home. And that is a big chunk of dollar-based costs. And then if Filecoin is like very low, that cost is very high, versus if Filecoin is like higher, then the relative impact of the margin is lower. And then what you also see in the data, plus on top, why I also feel it is important to take a look at that. And Filecoin, I guess, did that as well, because a year ago or whatever, they changed the protocol, the way you need to do the proofs and all the things. Don't get too into details. Basically cutting down the cost of proofs by 90%, over 90%, right? Just by making it more efficient. And these are the things. Pocket Network is another good example where we dig into to understand how can protocols first assess, okay, what's the cost base of my node operators, and like what can we do to make them more efficient? Because at the end of the day, if more and more node operators run red, it might not be good for the sustainability of your networks, just from the operational standpoint.
Have to react. Oh, I want to confirm.
Okay. Yeah. One thing that was not mentioned in the talk, and I'd love to get both your thoughts on, is kind of this. I guess this is more true for the Tendermint style chain with high inflation, and we've seen how difficult it has been for Cosmos app chains to maintain high inflation and keep their token prices afloat, and also have their validators continue to make money. So chains basically that don't have revenue yet, and this kind of illusion of profitability, when in fact you're being inflated away. Perhaps at some point your underlying token that you're staking will drastically reduce in value. Yeah, maybe just kind of touching on that, like what are the imperatives here that token holders, funds, validators should be thinking about when validating on the high inflation chains and getting these inflation rewards? But is it really revenue at the end of the day if your underlying asset is being deflated?
I mean, inflation is the design or handling inflation in a way that it's beneficial both for the protocol and all stakeholders involved is something that any protocol has to keep an eye on. And it's generally, this is designing economic systems. And I would say recently there are several very interesting approaches on mint and burn mechanisms, not even stemming from protocols or staking ecosystems. Also, we'll just have a conversation next week with Huddle. They have just published their white paper with an interesting mint and burn mechanism where you look at both sides. So how can we design rewards? And since you want to, or since we have this opportunity to reward with newly minted tokens and also then step by step grow our ecosystem in volume, at the same time, we have to always think about how to balance this, because otherwise it's just you hurt your own ecosystem.
Yeah. So what are the main takeaways?
I mean, just inflation, maybe to go that, like, there's different viewpoints from protocol perspective or like a stakeholder perspective in your investing. I mean, the way you can think about it is like, okay, this inflation-based issuance is kind of like similar to debt, right? Because you give them something and then I need to trust you that, okay, at the end of the day, I can cash it out whenever I want, generating sell pressure. Or if I believe that, we're growing, we're getting somewhere, I can hold on to it to, cash out later. We're very similar to debt if you think about it. So from protocol perspective, we're like, okay, you're basically financing your operations, issuing this debt. And the more you issuance, the higher the debt burden. And then you see this in traditional economies is like, there are economies like the US that can create a lot of debt and nobody cares so much because they're like, yeah, we don't have any choice. We need the dollar. Whereas there's some economies that also generate a lot of debt and they're just like, okay, your exchange rate goes sucks, right? And so you as a protocol, it comes like when you take this perspective is like, okay, what do you do with that? If you just maintain your operations and there's like, okay, the validators keep a blockchain running, okay, that's a good basis, but you need something on top, right? And that's, for example, like Koschig is an example where I saw they had the staking rewards, they got a validation running, they got their product out, but then they started to realize, okay, generating more traction, we maybe cut into that emission not to only incentivize the supply side, but also go for the demand side. And this is something where like, yeah, that makes a ton of sense because at the end of the day, there needs to be revenue or at least an outlook for existing issuance holders to believe, okay, this is something. And they get that by, okay, there's traction, there's real demand for it, but also outside token demand generated through that, right? And that's the play you can do. There's obviously also other perspectives where it's more about Ethereum 2-3%, Solana 5-6-7%, where you can think about, okay, if I can get that as a staking, as kind of like a risk-free yield, like making this comparison, that has impact on your DeFi ecosystem, for example, right? And this is the other perspective. Again, you as a protocol design, what do you actually want to enable, benefit on your protocol? Because then again, you can also make more adjustments to your design to maybe help foster that if you really want that. But I think that perspective is something that protocol designers or like founders should keep in mind that, okay, at the end of the day, it's like, okay, how much how much capital you want to raise with a debt that the debitor can cash in at any time.
Yeah. And we've seen a lot of chains, especially Tendermint chains, Cosmos SDK chains in the last cycle, just issue tons of debt and never be able to repay it with actual revenue. And I love this. I love this analogy with traditional economies. I think it is very apropos at this particular time in place. Thanks so much. This has been really fascinating. Enjoy the rest of DevCon and Bangkok.
Enjoy as well.
Have a great DevCon.
Yeah.